Welcome back. You're with us on Closing Bell, and we are in the last half hour of what's been yet another challenging week for the market. And even as we speak, the market's been making fresh lows at the index level. So what next? Look at that, 130 points, still lower on the Nifty. What next? Sunil Koul, Global Emerging Market Equity Strategist at Goldman Sachs, is with us now. Sunil, thanks very much for joining in. I know that's a tough question, but let's start with the flows picture, because you folks have been analyzing this absolute exodus that the market here has been seeing, right, from foreign investors. What's the sense and what's the chatter that you're picking up? Because these days, it's a daily sell figure of 4,000, 5,000 crores. I mean, it's not even, it's a one-way move. There's absolutely no reversal coming through. So what is the mood out there?
Yeah, no, that's right, Surabhi. I think if you looked at the pace of foreign selling, I mean, from the peak, we have seen close to $20 billion of foreign selling in India, which I think if you put that in context, that's the second largest selling India has seen in terms of absolute numbers. And also, if you look at the percentage of market cap, that's 40 basis points. But I would say if you sort of look at the selling, it sort of started with the China stimulus trade back in sort of peak of September. And then I think as we started the earnings season in October with the cyclical slowdown that we have been seeing in India, people have started to sort of exit. But I think it's a combination of the broader sort of macro backdrop for the emerging markets not that great, with sort of dollar being stronger, rates being higher. Obviously, a lot of the expectations were around sort of tariffs. And so in that environment, we have been seeing people pulling out money across emerging markets. And so the sentiment is a bit cautious, which is kind of in line with our view. So I would say it's a combination of sort of global environment not being as supportive and Indian fundamentals kind of seeing a slowdown in terms of both growth and corporate earnings, which is why we are kind of seeing a sell-off in the markets. I think bear in mind the starting point in September, because we had two strong years of Indian equity markets outperformance. And so at the peak in September, the market was trading at 24, 25 times PE, which is even above the peak valuations in 2007, right? So your starting valuations were pretty stretched at peak levels, and then you sort of started to hit the corporate earnings downgrade cycle. Combining that with the fact that the global macro backdrop has been tougher, I think that's why India, being the most expensive market in emerging markets, has been seeing quite a bit of FI ceiling.
Okay, so you raised two separate points, Sunil. One is the global backdrop, and then we have our own issues, local issues, earnings and slowdown. We'll come to the second one in just a bit. Let me just complete the picture on the first one. Now, as far as these global uncertainties are concerned, I completely take your point, because the dollar was going through the roof as we were getting to the 20th of January, right? But now that seems to be kind of settling somewhat. US yields are not going completely haywire. The dollar's now found a range. Oil prices are actually going lower. And at least till now, we've not seen some absolutely out-of-the-park announcements on tariffs, neither on India nor on emerging markets.
So that's right. Yeah.
So is it too early to say that at least the global piece is settling, or do you think we should not take that too lightly either?
I think it might be a bit too early, because, I mean, if you, for example, looked at what happened pre-US elections, obviously we were expecting dollar to move higher, rates to move higher as well, which is why when we were framing our expectations for emerging markets, we were a bit cautious on the markets. Obviously, I think post-US elections, many of these moves were even sharper than what we had anticipated, right? So as you said, dollar was at sort of multi-year highs, at 35-year high. If you look at it on a trade-weighted basis, rates were spiking. I mean, the things have stabilized in the last couple of weeks, which is why I think the markets also global markets have taken a breather. But I think our sense is that if you, for example, look the strong move in dollar, a lot of that can be explained by the fact that US economy and US data has been much stronger than elsewhere. And obviously, we saw the repricing in rates, so we are expecting lesser Fed cuts, whereas we do think that ECB will continue to cut. We will think China will continue to cut. And so if you just looked at rate differentials and growth differentials, I think that could explain most of the move we have seen in the dollar. The key point, therefore, is we don't think that the moves in tariffs are largely in the price. Obviously, I think the news flow we saw on the tariff after the inauguration day were somewhat kind of less hawkish than what the market was anticipating. And so there's a bit of sort of relief rally on the back of that. But we think there could be more sort of headline risk around tariffs as we go through the first quarter, which is why we still think dollar may be stronger so on a trade-weighted basis and on a DXY basis, especially if we see weakness in yuan and weakness in some of the other and weakness in euro. that could put dollar higher. So I think we are not still out of the woods regarding the global situation, which is why our sort of view on the emerging market remains that we'll stay sort of range bound or cautious in the next 3 to 6 months.
All right, so you just hold that thought. We need to address some numbers that are flashing for you on the screen. And Laurus Laboratories is the stock that's moved to the high point of the day. And the reason is after 6 quarters, the margins have returned to around 20%. We have got very, very used to saying that Laurus Laboratories is guiding for better margins in the next quarter. And that's happened for all of 6-7 quarters. And now the margins have come in at around 20%. The top line as well at around 1,400 crores. That as well as after nearly around 6 quarters. Explains why the stock has moved to the high point of the day as we speak. It's up close to around 3%. So the margin's back at 20%. Thumbs up. And that's why that stock is relatively outperforming at this point of time. We'll wait for further details, but prima facie, those numbers look good. Revenue growth, margins as well look quite good. Good expansion on a sequential basis, 15 to around 20%. Sunil, apologies for that. We just need to take stock of some results that are coming in there. But Sunil, give and take everything. What Trump is doing, what he's saying, the currency volatility as well, and the Fed, we don't know what they're going to do. I think here in India, all eyes are on some monetary policy. And hopefully there'll be some kind of loosening out there because it appears as of now at least the liquidity in the system is very, very low. And I think regulator will have to take a call on that. Assume that we do get a rate cut in February or so and the budget doesn't have any negatives. Do you think the Indian markets can at least perform in line with the global equities? And I ask this because the way the FIs have been selling, we have been underperforming as well. And we've gotten used to at least being outperformers. But now can we be market performers at least?
I mean, that's a great question, Nigel. Look, I think you are right. We agree with you on that. So if you sort of take a step back, we took our view on Indian equities sort of from being overweight for the last couple of years to neutral back in October, which in hindsight was a good timing. But the main reason for that was that we were expecting the cyclical slowdown in growth, which largely was, in our view, was largely driven by both fiscal being tight and monetary policy being tight. Obviously, as budget comes through, we still think that there is not much room to ease fiscally, so they will still go for fiscal consolidation. But on the monetary side, to your question, we do think that monetary policy is going to ease. So I think as you mentioned, the RBI has been keeping liquidity pretty tight because they were supporting the currency in this strong dollar cycle, and that's why the interbank rates were pretty high. But we think as they move into the February policy, they will ease liquidity, and so I think liquidity conditions will start to become better. But also we are expecting 2 rate cuts, one in February and one in April, 25 basis points each, so 50 basis points of easing. So that at the margin should be helpful. So I think if you therefore think about the causes of slowdown, I think there is fiscal tightening, there was monetary tightening. There's obviously was all the macroprudential measures that RBI was taking with all the unsecured retail credit, as we know, and there is obviously the consumption slowdown. Out of all these factors, as I said, fiscal will remain tight, but monetary easing at least we should start to see. I think that should be helpful at the margin. And then I think we are already seeing the credit slow down over the past year from 17-18% of the credit growth to 11-12%. So I think the bulk of the credit tightness that RBI has been doing is also kind of sort of stabilizing. So our sense is that you probably see range-bound markets 3 months or so, and I think as we get deeper into the year, more into the second half, the market should see a stronger recovery because by that time, your earnings cycle should start to improve.
How do you define a stronger recovery, Sunil, in the second half?
Yeah, so if you look at our targets, Surabhi, so we have 23,000 on Nifty by March, which is where I think it is roughly. So we have flat target in our numbers, and obviously markets have been weaker. So as I said, when we downgraded the market back in October, since then the market is already down 13-14% in local currency terms. And obviously, I think beneath the surface, as we know, there has been a lot of carnage in some stocks. And so I think market has already corrected. We have gone from 24-25 times PE to 22 times PE. So our fair value, where we think India's fair value is more like 20-21 times. So I think a large part of multiple correction has happened. We think there's a little bit more to go. We also think that earnings for this year, calendar 2025, are at 16%. Consensus, we are at 13%. So we do think there's a little bit of more earnings risk, which is why I think on the 3-month basis, as I say, market probably is going to be range bound as we as we digest some of the more earnings downgrades and a bit of more multiple compression. But then in the second half, we think there could be a stronger recovery in line with the underlying earnings growth, which is 13% for us. So we think market would be close to sort of 13-14% in the second half, going back to 27,000, which is our Nifty 12-month target.
You're saying 13% earnings, that's for FY26, is it? Or are you looking at calendar year?
Calendar 25.
Calendar 25, got that. So 13% earnings, calendar 25, and a stronger recovery, taking the Nifty to 27,000 by the end of the year, basically towards the end of the year.
Yes. Yes.
12 months, got that. Nice.
Sunil, looking at the screen, the bulls will be very, very happy to hear that, because things are looking very, very jittery. These bounces are getting sold into. And a market participant, I was speaking to him yesterday, he said that, Nigel, the way liquidity has been so tight, it's like I broke a signal and you're sending me to jail for that. That's how equity market participants are feeling. But, there'll be sectors and themes that will do well. And I think you all have been underweight, if I'm not mistaken, on the financials. I think there was a consensus out there that they will do well. But actually, banks and financials have underperformed. What do you like correct. As of now? The top theme that you'll have, I think you'll be reasonably positive on autos, on insurance as well. So give us the top two sectors you're positive on.
Yeah, look, I think as a broader view,
Oops. All right. I think we'll try to get Sunil back, to hear out his the two sectors that he likes. We'll just try to fix that in a bit. In the meanwhile, markets well stabilized. We saw a sharp downtick. ICICI Bank, that's the one that's trying to pull its hand up and try to be counted. As we speak, a mild recovery is what we're seeing on ICICI Bank, but it has a decent weightage, and that's why that's helping out. Sunil, back to you. I think we have you back on the line. The top two themes you're giving us.
So as I was saying, Nigel, is that when we lowered the market, the core sectoral thesis was that you want to reduce cyclicality in your sectors, and so we have taken a much defensive allocation in our sector recommendation. So we have upgraded IT a few months back. That remains our top sector in terms of the defensive sector. Obviously, a lot of that is in line with the stronger U.S. economy view. We have 60% of the revenues.
Oh, I think we're having a bit of an audio issue. Unfortunately, Sunil just lost that audio. Don't know, do we have him back? Sunil, can you hear us? No, I don't think we have that line fixed. So we'll wind it up on...
you.
Oh, we can.
Oh, okay. Now we can hear you. Sunil, if you could just quickly complete that point. And also, I just wanted to end by asking you, this recovery that you're speaking of, right? The hope of corporate earnings reviving. And you said that don't expect too much of, fiscal easing.
Right.
It's going to be more monetary. So I want to end by asking you, this is a classical debate, right? Is it going to be enough? Will 50 basis points be enough to get us that, earnings trajectory back on track? What makes you hopeful?
See, I think on the slowdown, you're right. We are underweight banks. We are underweight infra, which goes which is in line with the fiscal still being tight. But even on the consumption side, Surabhi, as you know, I mean, it's not homogeneous, right? You still have high-end consumption doing pretty well. You still have signs of rural recovery, and autos have been doing well. So in terms of the sectors, we think that if you can, I mean, given sort of our positive view on the IT sector, I think from the consumption side, autos could do pretty well. We think the defensive sectors like insurance and telcos can still continue to do decently well. Real estate cycle is still being strong, so we are still overweight real estate, and we like some of the real estate late cycle plays, pipes, ceramics, tiles, all of that. So I think there are definitely sort of export pockets, IT, and some of the domestic pockets where the demand visibility is still strong. Even though your financial earnings might remain under pressure and the capex sensitive sectors like cement and industrials may not see a strong pickup, I think that you can still see a decent sort of double-digit earnings growth, as I said, 12-13%, which is slight pickup in volumes and a bit of margin expansion.
Got it. And I think the market will take it with both hands, considering we'll probably end at some 5-6% for FY25. Going back to 13%, I think will be very, very well received. Music to the bulls' ears. All right, Sunil, thank you very much. Have a great weekend, and we look forward to more of these conversations in the coming weeks and months. We'll take a break on that note, come back on the other side. And then, of course, some final trading calls for today.